Yeah, look, a big part of this business, at least from our side, is how do you approach things from a practical standpoint. And there are points where you chase strength for sure, and we were doing that in April and May of this year, right? And it's not easy. I'm not going to sit here and say, oh, that was so easy. Psychologically, it's actually very, very hard. But we just know the data, and we've been doing this long enough that we know there's places that you want to be doing that. This is not one of those places. You've got roughly 60% of the names in the S&P 500 that are above their 20-day moving average. So it's an okay number, but it's certainly not a number that's at new highs. With the market, it's not a momentum type market. And so what that means is, generally it's 3 steps forward, 1 step back, 3 steps forward, 2 steps back, that kind of scenario. So when you marry that with sentiment, that really kind of locks us into saying, okay, we want to be careful with some of these names as they get extended, while the rest of the market, is kind of in an average state, if you will.
RenMac Off Script originated as a weekly internal research meeting designed to summarize and discuss what happened in Washington, the markets, and the economic data over the past week. It was always intended to be and remains a free-flowing conversation with no discernible objective other than to extract the wisdom and opinion of our analysts and their expertise. This is a conversation among colleagues. Individual circumstances are unique and nuanced. Do not mistake these conversations for investment advice, because it's not. Here we go.
All right, welcome to RenMac Off Script, where we openly discuss markets, economics, policy, history, and life. It is payroll not Friday, October 3rd, 2025. I'm Steve Duttenhofer.
I see what you did there, Steve. Nice. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
So welcome back, Neil and Steve. You guys were on the road this week. Neil, you were in London, right? Steve, Chicago?
Mm-hmm.
What did you guys find out?
Neil, uptick on London. Was it better this time? Are you?
I've always been a fan of London. It's Paris that I detest.
Oh, I see. I got it.
Paris is one of the most overrated cities, I think, in the world. And London, though, it was a fantastic time. I had Indian food twice while I was there, so that was good.
How much better is Indian food? How much better is it in London than it is in New York?
It's better, for sure. I think the gap is narrowing somewhat. I went to this great place called Ambassador's Clubhouse. Really nice dining room and just great experience. Good time. No, I like London. As I say, it's Paris and the French that I can't stand. The upshot for us is it's okay. It's okay for me to say so, because as is widely known, we know that Paris isn't a big macro research town, so we're not really offending many clients by saying that.
Fair.
Well, fair. We're not getting any either.
London, Toronto, Boston, these are the big macro towns, I think, in the globally. So
what were clients asking about? Because it's always important to know what clients are thinking. We kind of, sometimes we get in our bubble. We think we know what people think, and it's part of the art of this business.
I think it's really about obviously we have a more cautious sort of predisposition these days, and so that's sort of new for us. We're generally, most people know us as sitting on the sunnier side of the mountain. The pushback that we get is basically stocks are at highs, wealthy people are spending, and, there's this AI CapEx boom, right? So, we kind of give our view, the housing market, labor markets are slowing down. That presents risk for consumer spending. Fiscal policy is tightening or tight. And the pushback we get is what I just mentioned. I guess what I would say to that, people were receptive. Because I think in many cases they haven't really heard someone sort of present the other side, and I think they appreciate that. But I would just say that AI, CapEx, stocks at records, wealthy people spending, those aren't actually 3 different things. Those are derivatives of the same thing. And I think that's just worth keeping in mind, right? Like the AI story is what's pushing stock prices higher, and that's incentivizing, maybe wealthy people to draw down their savings. So if the labor market slowdown, as an example, starts to come for white collar, kind of professionals, that's something to think about. And if, let's say for whatever reason, do you get a situation where, earlier in the year you had like a DeepSeek kind of thing, and that kind of took some of the enthusiasm out of the AI trade? Does that create the potential to spiral into something worse because enthusiasm for AI is so high? I mean, one of the things I've always said is that I'm a big believer in the notion of like an element of surprise. This was one of the reasons why we didn't think a recession was likely back in 2020, late 2022, early 2023, is because everyone was expecting it. So if you expect something to happen and it doesn't, you have to play catch up. By contrast, the risk is in the other direction now. If you were to like strip out like what is the market implied probability of recession, it's probably lower than historical norms, like maybe less than 10%. Typically in any given year, it's 15 to 20. So is there a situation where you get a little reflexivity, right? Like the market prices in a little bit of recession risk, and that creates expectations of a deeper problem. So it's something to think about. But yeah, I mean, it's, the pushback was there for me. I mean, our view, people seem to be on net, fairly optimistic. And that's what I took away.
Paz, what'd you pick up in Chicago? Anything different, or everybody just rallying around the Cubs?
Well, I was actually there when they lost. I guess they're probably happy to get rid of me. But in terms of like big themes that I sort of saw across the meetings, obviously trade and tariffs were a focus of every meeting. There are a lot of questions, regarding why has the economic impact been relatively muted, and I think we sort of talked a few reasons for that. I think one thing that a lot of forecasters got wrong was this idea that other trading partners would retaliate. And right now, China's the only one that's still retaliating. Canada did for a little bit, and they've sort of backed away from that. So I think that's one that just universally many forecasters got wrong. The other thing that I think that we've seen sort of bear out is a lot of mitigation. You've seen the tariff rates that went into effect in August. They were in most cases lower than what had been announced earlier in April. The thing to keep in mind is they're just starting to go into effect, just like the sectoral tariffs. So we'll see, moving forward, as time goes on, are these economic consequences going to play out more along the lines that were being predicted? We'll see. The thing too, sort of related more to Canada and Mexico, the idea of exemptions. 35%, 25% tariffs sound good politically for Trump. When you factor in all those USMCA compliant goods, the actual rate's probably closer to 7 or 8%. So I don't know that people always necessarily appreciate that. One thing that was underappreciated, I sort of remember this from my time in the Treasury Department before, is this idea of the universal baseline tariff. I know it's a revenue generator, but I think it's really important for the trading partners and there's conversations, is because it really prevents a tariff arbitrage opportunity. This idea, a lot of times with other trading partners, believe it or not, they're less concerned about what their rate is. It's more what the rate isn't for other people. They don't want to lose that business and opportunity elsewhere. So I think that may be something that was underappreciated. At least that was sort of the feedback I got there. The other big topic was this theme, and I think you actually saw it right before we went out to Chicago, of this expanding sort of more muscular industrial policy, which again is just a polite way of saying greater federal involvement in businesses. We had this announcement, the administration looking to take an expanding interest in some lithium production, as well as this Trump RX with this deal with Pfizer. And I think Trump's drawing a through line here. People are sort of asking, is this trend going to continue, and where should I look? And the answer was yes, it will continue. And right now we've seen it really apply to all these industries that are deemed strategically significant. So all you really have to do is look at the Section 232 tariffs to identify, here are the sectors that the administration really wants to bolster domestic production, and in this case, more federal government involvement. We've seen it in steel and aluminum, we've seen it in semiconductors, pharmaceuticals, critical minerals. So that was sort of the guidepost that I provided that I think seemed to resonate with folks.
Well, I want to get on to the shutdown stuff and see if those negotiations will happen and whether or not they're going to continue to work. But Jeff, Neil pointed something out in his commentary about some sort of complacency, right, around thoughts around recession and the market, maybe getting ahead of itself, so to speak. You had some work this week around put call data, right, sentiment, yellow flags around that. You want to talk about that a little bit?
Yeah, sure. I mean, just recently, and I think it would be a yellow flag. It's not a red flag yet. When we look at our put call data, so just for those who are not versed in sentiment. We look at the volume of puts traded versus the volume of calls traded. Obviously, a call is a bullish position, a put is a bearish position. There's a lot of philosophical reasons why that simple ratio shouldn't work, whether you're opening a trade, closing a trade, et cetera. I won't get into all that. But the data just shows that it does work. So it's one of those things where you can sit at the blackboard and complain all day long about why things work or don't work. And in the real life, they do or don't. And in this case, philosophically, they shouldn't be as good as they are in practice. Anyway, the point being that the higher the number of calls versus the number of puts, the more optimistic people are. And that might seem like a good thing, but actually it's a contrarian indicator. When people are kind of clamoring over themselves to get exposure, that tends to be bearish. Now, I think when we look at it, and we've got different ways that we do this, we have what we call our buyer's frenzy indications, which is measuring how much people are willing to pay in excess for that upside exposure versus that downside exposure, right? So if I'm willing to pay a premium to get exposure for the opportunity to have upside gains, but I don't worry about the downside, I might be a little reckless there, and that's what our data shows. So we're seeing it more in some of the semiconductors, not NVIDIA, by the way. I'm not going to list all the names that we have here, but if you're a client, you know how to get them. And there's a few, probably about 10 of them, that would say, hey, we need to take a pause here and just be careful. This is not a place for fresh money. This is not in any way an indication that we're going to top out and have a bear market. But in terms of being tactical, this is not the place where you really want to be leaning into it. You want to let people's kind of emotion and their exuberance play out, and you can sit back and pick up the pieces when they're whatever the case may be. As Neil said before, right? You had a DeepSeek that was kind of out of the blue that put these things in a spin for a quarter. Those things happen. I mean, that's just the way it works, and they're more. You're more vulnerable or susceptible to them when people are overextended, and that's where we're seeing it in some of these instances. So again, I think it's tactical. I think it's very specific in terms of industry groups and in sectors. We're not seeing it across the board, but it is certainly something that caught our eye this week.
But then in that environment, how you think about investing in specific names or ETFs or whatever, you're not chasing strength, right? You're buying weakness. Is that right?
Yeah, look, a big part of this business, at least from our side, is how do you approach things from a practical standpoint. And there are points where you chase strength for sure, and we were doing that in April and May of this year, right? And it's not easy. I'm not going to sit here and say, oh, that was so easy. Psychologically, it's actually very, very hard. But we just know the data, and we've been doing this long enough that we know there's places that you want to be doing that. This is not one of those places. You've got roughly 60% of the names in the S&P 500 that are above their 20-day moving average. So it's an okay number, but it's certainly not a number that's at new highs. With the market, it's not a momentum type market. And so what that means is, generally it's 3 steps forward, 1 step back, 3 steps forward, 2 steps back, that kind of scenario. So when you marry that with sentiment, that really kind of locks us into saying, okay, we want to be careful with some of these names as they get extended, while the rest of the market, is kind of in an average state, if you will. So yeah, buy pullbacks, buy consolidations, and that's anywhere from 5 to, in specific names, depending on beta, maybe 15%. That's not a market call by any means, but that's an individual stock call that you can get some of these drawdowns or consolidations that don't change the trends. They don't change where these stocks are going to be 3 years from now. They're just these temporary setbacks. And it's very easy. We hear this a lot. Very easy for people to say, well, that's fine. I'm just going to wade through it. The problem with that is when you get a 25% drawdown, then all of a sudden the narratives start picking up as to why maybe this isn't the case anymore. And you're the sucker selling it at the lows as it was just this consolidation. So it's about, just like in poker, it's about playing from a position of strength, not weakness. And that's exactly how we're thinking about it right
now. And being nimble and being able to adjust in the regime that you're in.
Correct.
Right. All right, let's talk about Shutdown. Different this time, guys? It feels like it is, but maybe it's not.
Yes and no. I'll use Jeff's, poker analogy. We have a fair amount of, trying to determine how strength everybody's relative hand is. I guess what is similar this time is we've had a lot of shutdowns. They've just become more frequent. And I think the thing to take away is you're looking at the market reaction. They're familiar with them, and they tend to recognize them for what they tend to be, and that's political brinksmanship, which is why I don't see much of an impact right now. If we're still in a shutdown a month from now, maybe that'll be a little different. And I think part of the reason is usually because of that, there's minimal economic impact. Usually furloughed workers get repaid. I worked at the Treasury Department. I was repaid when I came back. It was almost like a snow day because only 2 or 3 days last time I was there, to be honest. That said, what's different this time? You have the parties on different sides. Usually you have Republicans using shutdowns as an opportunity to try to force concessions. This time we have it reversed. You have Republicans sort of pitching the idea, let's keep the government open. Democrats trying to use their position in the minority to force some concessions. The other thing that may be different this time is we talked about furloughed workers. You have the Trump administration considering the possibility of pulling the ripcord, reduction in force, layoffs. So, will they actually follow through on that? And if so, what will the scale and scope be? That would be different because at this point, you wouldn't have any workers returning to back pay. You would have just people losing their jobs. One of the reasons I think that the administration has been reluctant to do that so far is you have competing voices. You have some Republicans that are sort of more along the let's keep the message simple in terms of let's just reopen the government. If you sort of inject layoffs here, is that going to make the message more difficult from a Republican standpoint, create an opening for Democrats? But you also have fiscal conservatives. I don't know that Trump's necessarily in that camp. He does like that a lot. But you look at, again, people like Russ Vought, who's running the Office of Management and Budget. Their argument is if these people are not essential and these functions aren't essential, then why are the taxpayers funding it? And there's definitely a camp that sort of, decides to that resonates with. At this point, I think you'd rather be the Republicans and that have their bill with the support of 55 senators and bipartisan support there in the Senate compared to 47 for the Democrats. We'll see. We're recording this morning, whether that vote count is the same this afternoon. If you start to see more Democrats move to that side, be surprised that happens today. But I think that's sort of what to watch, next week. Is there sort of that momentum building to do that? That said, if Trump decides to follow through with some layoffs, that may harden Democrats, and that could lead to a longer shutdown.
Neil, are economists just dusting off their playbook for shutdowns? This is what it'll impact, GDP, blah, blah, blah.
Yeah, I mean, it always gives you an opportunity to say the most predictable thing ever in Wall Street economics, which is an unexpected shock knocks 0.2 of a point off GDP every week that it goes on.
We're gonna put that in your tombstone.
I think, yeah, I mean, it's just, I mean, it's I've been around long enough to know that that's exactly what happens like every single time something like this goes on. But I think, I don't know how different it is this time. It feels a little bit different, I guess, at the margin. First they're talking about firing workers, not furloughing them. So if you fire someone, that's obviously different from their own mind than getting furloughed, right? Because if you're fired, that's a loss of income on a permanent basis. If you're furloughed, that's a temporary loss of income. So the consumption shock is going to be different in the case of being fired. The prediction markets are suggesting that people are increasingly betting on this lasting longer, right? Like, so, I take Steve's point that maybe it's going to be over soon, but for now, I think people are thinking so long as Trump and Vance are sharing sombrero memes, we're not really close to this ending anytime soon. And look, the stock market, is up, right? Like what's the forcing function, right? I mean, the data aren't being released, so we don't know how bad the labor markets are getting.
No data. The stock market's going up. The government shut down. That feels like it's right into Trump's playbook.
Yeah, but I would also just say, like, yes, but it's coming at a fragile time. Non-farm payroll growth has been slowing, right? We're not getting the BLS data this week, but when something like that happens, you should, try to seek out some corroborating evidence and think about what's happened so far this week. You got fresh deterioration to new lows for the Conference Board labor differential. So consumers are telling us that job finding is getting more challenging. Historically, that means higher unemployment. The ADP measure of private employment was negative, which it's been for 3 of the last 4 months. And the ISM Manufacturing Employment Index was below 50 yet again. So, do you really, and we know that job openings continue to slide. So do you really need the BLS data at this point to tell you something and these are all September data points. The last official measure of employment that was released was the JOLTS data. That's for the whole month of August, right? So the payroll data is sort of a snapshot in time. The JOLTS data is the whole month. And that was also soft. I mean, it's interesting. People talking. I mean, the Bank of America and their research department just came out with, well, the Fed's going to make a mistake because all the slowing in the job market's labor supply. Well, if it's all labor supply, tell me why hiring rates are as low today as they were in 2008. Right? Like, why is recruiting intensity going down? Is that because of immigration and labor supply? It's a joke. Why is the unemployment rate up in the first place? It's just interesting, right? I mean.
So great. So now you get all those things and you get pressure on the Fed to ease more, which brings rates down, which is what Trump wants anyway. Like, I'm only saying this because as a casual observer, I just don't understand why this doesn't go on for longer. It just feels like it's playing right into their hands.
If it goes on for, I mean, the issue, right, is the bond market has a different view of nominal growth than the stock market. That's the issue, right? Like, so I don't know. I mean, if you have a government shutdown, you're basically, and if it's as bad as people are starting to believe, like with actual firing of workers, then wages and salaries are going down, and that's already on top of the fact that in the first round of the Doge, a lot of people took the buyout offer, and so those people are going to basically roll off the October jobs numbers. You're going to get like over 100,000 federal workers just going poof in that data set, and historically, I mean, people that take deals like that tend to be older, and so it's likely that a lot of them won't be actively looking for work, so they probably won't show up as unemployed, but some of them will, and they're entering the job market at a very, very tricky time.
So then we get, lower growth, we get lower inflation, we start to move into that box, Jeff, in your market cycle clock, which is fantastic for equities going forward, right? That elliptical move that you talk about. I know you had a new data point that came out this week. So it just feels like we're setting ourselves up for exactly what, we want. Not we, but the markets.
Yeah, into that good zone, right? I have to say, after listening to that, I'm really disappointed in myself for not having had the foresight to somehow do one of those sombreros and mustaches on all of us as we started this thing off. I mean, I know it was a troll move, but I was on the floor, laugh out loud. I mean, just gold. Anyway, I wish we'd have thought about that.
Maybe we can put it in post-production.
As a post-production, yeah, possibly. Look, I mean, low inflation, deflation, let's call it a deflationary kind of scenario, and low growth, and I hold on here, is massively bullish for the equity markets, right? So it's about where the puck's going. It's about the policy changes. It's about all those things. We've got 70 plus years of history with this. And it is unequivocally bullish. Now, it is not the point in time where you're going to pick up the Wall Street Journal or the New York Times, or God forbid, listen to CNN and say, oh, I'm hearing good things, therefore good things for the equity markets. Absolutely not. You're going to hear bad things. You're going to hear how the consumer is on his back, how defaults are high, how just things are bad. That's where the puck is today. That's where the puck is, right? What you worry about from an equity market perspective is where the puck is going. And that allows the policy rates to come in, which means things are going to probably improve. Now, there's a delicate balance there, right? And Neil can talk to this, where maybe they wait too long and the initial policy move isn't enough. They have to catch up, if you will, to kind of get things right-sided. And that's the risk, that can be early. But generally speaking, and that's one of the reasons why we watch discretionary versus staples, and frankly, just discretionary by itself, is that you get a good sense as to whether or not the Fed has pushed things to the point where they've broken the consumer, and you see that in the equity markets, particularly in consumer discretionary stocks, or if these rates are good enough, these rate improvements or cuts are good enough to assuage those concerns and provide that safety net that then kind of fuels everything else. Right now, we're in the latter camp. That's not true wholesale. We've seen it in housing, as Neil's pointed out. We're seeing it in some of the construction material names. We're seeing it, frankly, in restaurants. We're seeing it in some of the hotel names. So there are pockets of weakness that, unequivocally we have to concern ourselves with. But holistically, as we look at this, particularly as it relates to the defensive side of the ledger, we're still in a decent spot. The one outlier, but this has been happening for a while, would be utilities. Utilities have been on a risk-adjusted basis, one of the best groups to own in 2025. Now, that's not just pure nitrogen, what you're seeing in terms of growth from, rate of change or returns. But if you measure that versus per unit of risk that you're taking to get those returns, utilities have been a home run. That's historically a defensive sector, obviously. And so, we have to be mindful of that. But again, a lot of that seems to be AI related, which is kind of, getting everything caught up in the market of that narrative.
All right, let's move to the mailbag. We got a ton of questions this week in the mailbag. We had posted our picture of golf balls. I think it was post Ryder Cup. We may have to put that in storage now, but got a lot of great questions this week.
I think we posted that picture like 5 times. I don't know who's in charge of that social media post, but I'm like, what is this, a golf ball ad or what are we doing?
Well, I took the picture of the golf balls. I was so impressed with my ability to take.
It was a good picture, but we posted it like 5 times. Like
I got a lot of golf balls. I'm holding more golf balls than I am hats. I got to get.
We heard on the last podcast that Harry likes the golf balls for sure. So I thought maybe that was his.
He does. We get big golf balls. But in any case, going forward, you guys know golf balls, hats, whatever. Please put your questions out there on Twitter. We have a form on there to get those questions in. We love hearing from everybody. So, Harry, good morning. We'll leave it to you to read off today's question.
Good morning, everybody. And today we have the question come from Dow Kroger. His question is, question about healthcare this week. The rip on Tuesday and Wednesday was more than impressive. Is this simply a decade bounce, or could it be their turn to come out of hibernation? Thank you.
Dow, good to hear from you.
The Dow Crocker? The Dow Crocker.
The Dow Crocker.
Who, by the way, I hope I'm not revealing too much, coached Little League, and 2 of his teammates or his players when he coached Little League were none other than Matthew Stafford and Kershaw.
That's
why they're where they are, because of Dow's just 100% coaching ability there.
Well, the real question is whether or not Dow coached Scotty Scheffler too, because I believe those 3 came from that same high school, I think.
Oh, wow.
How about that?
Trifecta.
There you go. So,
I'll take that question,
sure.
But I definitely want to hear from Pavlik on this from the policy side. Look, healthcare has been in this zone. We call it CIRM in our work, which stands for Standardized Excess Return Model. Might be the worst acronym ever, but it does fit. Basically, what we're doing is we're measuring alpha over an extended period of time. And the idea is that within capital markets, i.e. equity markets, alpha tends to mean revert. You can't have too much alpha that's, just is outside of kind of the bounds of capitalism and efficient markets, right? In other words, you can't have more risk-adjusted returns in perpetuity. That just doesn't make sense. So if you have a lot of high alpha, you'd expect things to revert back and, competition to come in, et cetera, all the things that happen in capital markets. On the other side of that, when you have too much negative alpha, that's the recipe for bankruptcies and consolidations and mergers, et cetera. And that actually tends to be bullish. So things are so bad that they're actually good, right? In other words, you can't, no matter how hard you dig, you're not going to dig yourself to China. No matter how great things are, trees don't grow to the sky, right? That's kind of the thinking there. Healthcare is in that zone, in the bottom zone, where, you'd have to dig a lot more historically to expect that things are as bad as they are. I mean, it's bleak to say the least. So that's good news, right? You're kind of in that zone where we tend to find bottoms. Now we look for relative performance. We look for some other things to kind of capture that and signal that. By the way, this series that I'm talking about is exactly the sequence that we used to make our China call, right? And that was almost 2 years ago. So you are in an interesting zone here. The relative performance, unfortunately, for healthcare has not been as strong, particularly in the mega caps. And even with this rip, as Dow called it, we haven't turned these things enough for us to be satisfied on that relative basis. And trust me, if we're coming out of this, it's a long, long runway. We don't have to buy it the second day these things are going, right? Now, maybe it's helping to start or form this bottom. That would be good news. I would say the most impressive part of this that I've seen has actually been what we've seen in small cap healthcare over the last, call it 2 to 3 months, which has been a definitive improvement. In fact, they are leading the large cap by a significant margin. And we've been recommending to clients, if you want to be in healthcare, be in small cap healthcare. And that's worked, and it continues to work very, very well. The large cap is still, I would say, debatable. So we'll see. I mean, a lot of this was policy driven, which we'll let Steve talk to. But usually you'll get these kind of policy spikes and then they'll come back down. And, they're kind of these long plays on how does this really translate into changing the business. And that's very, very typical of a bottom, which is good news. But I wouldn't be in the zone of chasing these right here. I think you'll have an opportunity for them to settle out. And if they're going to turn, we'll start to see that improvement in the relative performance and the like as we go.
Yeah, I'll just add from a policy standpoint, it's probably not a coincidence with respect to the timing. You had the Monday was the deadline that Trump had given drug makers to comply with his most favored nation's pricing proposal, i.e. bring your prices down or face some to be determined federal consequences. And lo and behold, on Tuesday, you had this announcement with Pfizer to sort of roll out this Trump RX to bring prices down. And then you had Trump say on Tuesday at the press conference that he was optimistic to strike similar deals with pharmaceutical makers moving forward, and that he would pause the sectoral tariffs on pharmaceuticals moving forward. So we'll see how long that pause goes. I would worry for some of those smaller manufacturers potentially, because if the pause, lapses and those tariffs come back, it's those large pharma names that are able to sort of meet Trump's demand to make this investment in the U.S. to avoid the tariffs. I don't know if smaller folks overseas will be able to do that. I think that'll be important to watch moving forward. In terms of healthcare broadly from a policy standpoint, I think there's just a lot of uncertainty right now. We have these debates about what's going to happen with the Affordable Care Act subsidies with regards to the shutdown. We also have potential legislation moving at the end of the year with pharmacy benefit manager reform. We have a lot of new personnel at the Health and Human Services Department, and what does that mean for vaccine and drug approvals moving forward? So I just wonder, again, with all this policy uncertainty over healthcare, are you just better off moving into other areas that there's just less uncertainty from a policy perspective? Perhaps there's something to that. But I recognize that, when I'm a policy hammer, everything looks like a nail, but at least that's how I'm seeing it.
That's great. Dow, we'll get you a hat in case you're still coaching Little League, golf balls in case you want to tee it up with Scotty down there. Thanks for the question, though. Good stuff. Neil, what are you watching next week?
Yeah, and if you're looking for a fourth Dow, I'd be happy to join you and Scotty and whomever. So just putting that out there.
Dut. That would be the fourth.
So the new season of Love Is Blind just dropped. That's what I'll be watching.
Can I ask you a question? Because this came up the other day. So this is a reality TV show for blind people?
Oh my God.
No, I say that seriously. Somebody told me that the other day. I don't know, and I bought it. They're like, "Oh yeah, it's Love Is Blind. It's for
Love Is Blind is a reality show where the people on the show are talking to each other behind a wall, so they don't get to actually see each other.
Oh, okay.
Before they meet face to face. So you get engaged sight unseen just by talking to the other person. And then you basically go through like a, month-long or multi-week-long experiment where you decide whether or not to get married in the end of the show.
It's like an arranged marriage.
Yeah, you're familiar with that, right?
No. God, was that an attempt at an Indian joke that failed miserably? All right.
Come on.
If you don't want me to sue your ass, you can deposit. You can deposit
I've got
a couple $100,000 in my bank account. I'll give you the. I'll give you the.
It is like an arranged marriage, but except there's no arrangement. It's just somebody's blocking.
Well, no, I mean an arranged marriage is where you don't actually talk to the person before. It's there is some choice in it. At any rate. that's what I'll be watching because the government shut down. There won't be any data to go through. And the only thing really is the University of Michigan data for October. That'll come out at the end of the week. So it'll just give us, that's going to be an October data point. It'll give us another sort of indication of how consumer sentiment is holding up, during the shutdown period.
Babs, what are you going to be doing?
I guess I'll be watching Love is Blind with Neil. Aside from that, look, I'll be watching the shutdown dynamics. We'll see whether or not there's an off-ramp provided. I guess maybe I'm more optimistic than most that perhaps this will be resolved towards the end of next week, perhaps into the weekend. Keep in mind, once you get an agreement reached, it's probably going to take a day or two just logistically to sell it to the members, make sure you have the votes. And a lot of that will be determined on those early votes in the week. Outside of that, I'll point out that the Supreme Court starts next week. And there are going to be a lot of cases this term that look at the powers of the executive branch, something that the Trump administration is interested in testing. And there are two cases that jump out, I think, that probably of interest to folks. Not going to start next week, but November 5th. That's going to be when the court examines President Trump's ability to impose tariffs under IEEPA. Those are the ones that apply to not only the reciprocal tariffs, but also the trafficking ones, Mexico, Canada, and China. And then in January, the Supreme Court is going to take up the Trump administration's request to remove Federal Reserve Governor Lisa Cook for cause over mortgage fraud allegations. The Trump administration wanted the court to act sooner. The court not only said we're going to take this up in January, so Cook will presumably remain in the role until then, but it's unique that Cook will be remaining in the role. The Trump administration has challenged to remove other federal officers, and they've been removed as their legal process plays on. So there is sort of a different application here by the court in terms regarding Cook's status. Whether that means they're going to treat her differently, I don't know. I'm not a lawyer. I'm just pointing that out. So those are two things to watch when the court comes back.
Jeff, you'll be watching the Tigers, of course.
Tigers, but I'll tell you what, I mean, I don't know anything about this Love is Blind stuff, but in our generation, Steve, Dutt, is, I don't know if anybody's seen this. This is kind of I can't do these series. They're way too long. I don't have the attention span for it, but AKA Charlie Sheen. Oh,
heard it's great.
Oh,
you think you know everything about him?
It was great. It was great.
It is.
You think you know everything about him, and you don't.
Yeah. It's fantastic. How that man is still alive, I have no idea. Yeah. I mean, talk about living with authenticity. Whoa, hello. Anyway, so the things we're going to be watching. Obviously, you talked about the market cycle clock, so that cyclical trade will be super, super important. How these buyer frenzy names start to react to that, if they power through it or not. Again, I think we're in the midst of a consolidation in those names specifically. Looking to Dow's point, looking for some softness in those healthcare names, but if they're able to hold up, get oversold, I think this is a months long call, plural, months long call, where they hold up and they trough and they're stabilizing. I think that's a good sign, particularly where that CIRM is. So it might be the early innings to keep it in that little league framework. I certainly don't think it's past its prime, but it's got more work to do to even see if the ball game's begun. So those are the things that I'll be watching. In just terms of what we're seeing in things like gold and things like the yields. I mean, all those are still in very, very solid trends. So any pauses, consolidations there, we think are viable not only in bonds but in gold as well. So that's how we're thinking about that.
Hey, Pavlik, you'll be watching Penn State football. For those that are listening to this podcast, they may not know that Steve's co-host on the Keystone Sports Network, right?
Well, interesting. I have not been brought back recently. They have a new deal with the NIL collective, and that is because I think the last one I was on before the season started, I pointed out many of the flaws we saw in the Oregon game. Look, I will just say this. One definition of insanity is doing the same thing over and expecting a different result. So any Penn State fan, and I usually put myself in that bucket because I am a Penn State fan, but if you expect that James Franklin, after 12 years, is going to win against teams of comparable talent, and that Drew Aller is going to deliver that as well, you really should seek the help of a mental health professional, because there is no way that that's going to happen.
Well, you finally found the passion.
Who's Michigan losing to this weekend, Dut?
I don't know. Do we have our coach back? I don't even know if we have our coach back.
I think you do.
Still suspended.
Wisconsin.
Yeah.
I will say Fickle's been maybe, well, Steve would argue with this because he thinks Franklin's been the biggest disappointment. I think Fickle's been one of the bigger disappointments of the coaching shuffles that we've seen in a long time. I mean, I was terrified when he entered the Big Ten, and he's been a paper tiger.
Yeah, he's been a nothing burger. Well, we'll end it on sports. Great place to end it. Remember, guys, watch us on YouTube channel. Throw your questions out on X. We post things on social media throughout the week. Get those questions in for the hats. But other than that, we'll be back next week when we'll be 1 week older, 1 week wiser. I'm Steve Duttenhofer.
I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
Thanks, everybody. See you next week.
See you.